In this video, we're going to conclude talking about incremental analysis. We'll look at a couple of more decisions that companies might need to make. So in this case, we're going to talk about replacing equipment. Should we repair it, keep it, or should we replace it? So let's start with this example. So we have a machine that originally cost $110,000. Has $70,000 in accumulated depreciation. So that means it has a book value of $40,000 and has a remaining useful life of 4 years. The company's thinking about replacing this with a new machine. The new machine costs $120,000. It has zero salvage value at the end of its 4-year life. And if the new machine is acquired, variable manufacturing costs are going to decrease from $160,000 to $125,000, and the old unit could be sold for $5,000. So the incremental analysis for the 4-year period is as follows. Now these are all going to be shown in annual, but 4 years annual combined. So we understand that every year we would have these line items, then we would just add them up. So what are the variable manufacturing costs for retaining the equipment? And they told us $160,000 times 4. If we replace the equipment, that's 104 times $125,000. So again, the difference between retaining and replacing is $140,000 increase in income. The new machine's going to cost $120,000. So that means that's an increase, that's a decrease in net income. And of course, if we sell the old machine, this $5,000 that we receive is actually an increase in net income. So the net income or increase or decrease, in this case, it is an increase. So if we replace this piece of equipment, we should increase the net income of the company by $25,000. Now, something for us to think about. Book value is a sunk cost, so we don't have to worry about it, right? Any costs that can't be changed by future decisions, we're talking about sunk costs, and therefore they're not a part of the analysis. But as we said, if we sell it, that has impact. So the cash disposal value, that could be negative even, or any kind of a trade-in allowance, all of those things would be incorporated because it's something that's going to happen if we replace. Finally, the last one to talk about here is what do we do with unprofitable segments, right? So let's think about how everything is related. We have these related product lines. Fixed costs are allocated based on some formula that we have, right? Net income is going to increase or decrease if an unprofitable segment is eliminated. We want to find out, that's really the question. What happens to net income if we get rid of this particular asset, right? This particular product line. So we're going to keep a segment unless the fixed costs eliminated exceed the contribution margin that is lost. So let's think about this. So we have 3 models of tennis rackets, Pro, Master, and Champ. So here's the net income. From Pro, we make $200,000. From Master, we make $40,000. And from Champ, we actually lose $20,000. So the question is, do we get rid of Champ? So how do we do this? Again, thinking about this problem, think about how you're going to calculate variable costs. How are you going to calculate the fixed costs? Because that's going to be important in our decision-making process. So let's think about this, right? How's it going to work? So let's put our income data here. What would happen if we get rid of Champ? Well, while we're thinking of that, one of the things we have to plug in here is, what's going to happen to the fixed costs? If I go back here, notice there's 30,000 in fixed costs to go with Champ. If we get rid of Champ, we're still stuck with those 30,000. So we have to figure how to distribute that fixed cost. And they assume that they're going to take this 30,000, they're going to do 2/3 to Pro, 1/3 to Master. So our fixed cost increased to 100,000. So that means our net income for Pro is 180. Master Champ, right? Again, Master, we're going to have with 60,000 is the change in fixed cost. That ends up with 30,000. So our total net income has decreased by 10,000. If you remember, the last slide here showed that we had 220,000 in income with it. We have 210,000 without it. So this is telling us that we should not get rid of this project. But let's see how we could do this with looking at this format, looking at income statement wise, right? So we had what? If we continue, we have 100,000 with the analysis of Champ, right? Variable cost are 90,000. Contribution margin is negative 10,000. The fixed cost, again, if we continue, it's 30,000, but if we get rid of it, it's 30,000. So this is what happens if we keep it, we continue with Champ. This is the cash flows associated with getting rid of it. So the fixed cost, again, we're going to save 30,000, but here we spend it. So when you subtract them, we get 0. So that tells us here the net income overall says we're going to lose $10,000 as a decrease in net income. What if we do not eliminate Champ, right? So again, excuse me, I think I just repeated that. So again, this just gives us that answer one more time. Let me get rid of that. So what if, though, 22,000 of those fixed costs can be eliminated if the line's discontinued? So essentially what they're saying here, part of the fixed costs of Champ will be eliminated if Champ goes away. So that means we're still going to be stuck with some fixed costs. So again, here's our contribution margin, is that negative 10,000. But now, right, we lose 30,000 because of the fixed cost when it goes away, but we don't get rid of all of it, right? We're still stuck with 8,000. So that means that the net income, 30,000 minus the 8,000, tells us that net income is going to increase by 22,000. Now we have a net income that's positive. So again, what they're trying to show us here with these relationships is you have to ask questions before you move forward with these kinds of things, right? What is the logical distribution of the fixed cost? If you get rid of a product line, do you eliminate any or all of the fixed cost with that line, right? It really is dependent on operations. So again, we've gone through, we've looked at 5 or 6 different techniques, or not techniques, different questions, different problems that companies can come across. And I think they're fairly common kinds of questions that all can be answered with incremental analysis. I look forward to seeing you the next time.